Financial experts are in the beginning of the year predicted what they call a bull year, with interest rates staying relatively the same at the moment. They may be reconsidering things, and we have some thoughts on that from Ernie Burns of Burns Estate Planning and Wealth Advisors. Good morning to you.
Morning.
The producer price index we thought was coming out about 10 minutes ago, so we're expecting a big inflation report at some point today.
Any minute. And what that's going to basically show is if inflation is settled now at 3%, which they were predicting earlier in the week at 2.8, that's why we had a bump in the road. But if that comes out a little bit more steamy than usual, then we're going to have a little negative, small negative day on the market, but maybe just another opportunity.
In overall, you predicted earlier a pretty good year for the market. You're sticking with that?
Yes, I did. My prediction was it would be very good, but maybe really much in the second half of the year. January produced a 4% gain in the S&P, a 3% in the Dow, and a 6.6% in the NASDAQ. So therefore, it took off a little faster than I thought. There's a lot of money on the sidelines, a lot of money in those money markets right now, making that 5%, but people see opportunities in the equities, and they're starting to take advantage of them.
Ernie, excuse me, I'm so sorry. Got something stuck on the throat in live TV. If there's money on the sidelines, that would imply that if people start buying stocks, that drives demand. I mean, stocks do go up sometimes just because if there's money in the market, it creates demand? Yes?
It does, but in the same instance, inflation's at 3%. It's the lowest it's been in years. So therefore, even though it didn't tick down to 2.8%, at least it's still at 3%, which is very manageable right now. So yeah, they might wait a while to lower interest rates. Like we predicted a couple months ago, probably not till June, but it's still a lower rate.
The inflation news we got this week was better than it had been in December, 3.1%, but inflation's still kind of stuck in that 3% range, and you get the sense that the Federal Reserve it just doesn't want to loosen the knob just yet. And fire things up.
They were predicting 2.8. So when the market tanked on Tuesday, down 500 plus points, what you've seen on Wednesday and Thursday the last couple of days is opportunity. So they bought on the dip, and it's been paying off right now.
There are a lot of factors that weigh into interest rates. I mean, I don't know if anybody wants to be on the Federal Reserve right now.
No, and this morning that PPI will come out, will help them with that. Also, mortgage rates ticked up. That is a negative, so therefore that's going to basically push the Feds maybe to lower interest rates a little sooner.
Sure, and I mean, it makes it harder. I know a lot of people who would really like to move up to a different house, maybe a larger house, but they're stuck because their interest rate on the house they own is so good.
It's so good.
For first-time buyers, really difficult.
That's right. So therefore, nobody wants to sell their house and go into a higher rate. If you got 3%, go to 7%. But here's what's happening from that, though. Now you have the builders, like D.H. Horton and others, that are doing really well building new houses because people have to have somewhere to live. So the economy is doing really strong and really well.
All right, we'll see where things go. Ernie Burns, thanks so much as always.
Thank you.